So let me just start by saying I always like to point to the disclaimer on all of my speeches that the views that I express here today are my own. They are not the official views of the Federal Reserve Bank of St. Louis or the Board of Governors of the Federal Reserve System. Also, we have there's a Federal Open Market Committee meeting next week. So basically there's a buffer of days around those meetings. They're called, we call them Blackout. Actually, if you look up Federal Open Market Committee Blackout, you'll see the official dates. So we're technically in that, which means in terms of kind of forward-looking monetary policy discussions, I have to stay away from that. And that's just because we want to make sure that when the governors and the Reserve Bank presidents who are voting members get together, they're free from that noise and they're actively not tipping their hats in any direction. But I'll tell you, having worked very closely with the St. Louis Fed president, I do get the sense that the Reserve Bank presidents and everybody else kind of come to these meetings 8 times a year, and I highly doubt any of them have a preconceived notion of where they're going to vote. It seems like a truly rigorous debate on monetary policy issues. That being said, and to kind of piggyback on Dr. Kelton's presentation, one of the big jokes around the Fed, or at least the St. Louis Fed, is that why can't we talk about monetary policy? It's basically irrelevant right now. And I think you saw some of that with Dr. Kelton's presentation, because we need growth, and that's kind of where we are. So a couple of things that I look at the St. Louis Fed. We look at risk. We look at risk to the banking system. We also look at risks to households, and I'm going to spend most of my time on that, on the household aspect today, because we think that's an important piece of future growth. And I think Dr. Kelton did a nice job of really talking about the importance of growth. So let me move you a few. I think it's good to take a step back. Dr. Weegley wanted something in a 70s, 80s rock genre. So there's the title of my, I think that's an Aerosmith song, Living on the Edge, in my presentation. And we do still believe that actively, especially for many households, that there's a certain tepidness to what's going on. But it was nearly 6 years ago, September of 2008, and this comes out of the Congressional Oversight Report for the Troubled Asset Relief Program, or TARP. But going back to those days, a remarkable 19-day stretch. The federal government took over 2 largest players in the mortgage market. Anybody remember those? Fannie, Freddie, right? Allowed a large investment bank to go bankrupt. Anybody recall 6 years ago? That was Lehman Brothers. Bailed out one of the world's largest insurance companies. We're still dealing with that one. That's AIG. And steered a major financial institution through the largest bank failure in U.S. history. Very few people actually get this one. Anybody want to take a stab at this last one? So we actually did steer an extremely large banking institution through failure right around this time. So this was Washington Mutual. It was actually a thrift out of Seattle, about, I believe it was $350 billion in assets at the time. So we're coming off of that. All right, so this is just a bit of a refresher on some of the headlines that we experienced, again, 6 years ago. We saw, referencing back to the Lehman Brothers crisis, we look at banks rushing to raise capital. Obviously, everybody's lining up to figure out what is going to happen in the U.S. economy. 9 major banks, according to the Washington Post, accept partial nationalization. A lot of them, Goldman Sachs, for example, became a bank holding company. So there was a clamoring to kind of access some of the Federal Reserve's facilities by institutions that hadn't been able to in the past. And then finally, I thought this quote at the Brookings Institution from Chairman Bernanke was particularly telling, because I think it's very real. It was kind of like you're in a car wreck or something. You're mostly involved in trying to avoid going off the bridge, and later on you say, oh my God. So that was coming up on 6 years ago. So what did the Federal Reserve do? Dr. Kelton talked about our core tool, and that is the federal funds rate. Reduce that to, I say 0 here, it's near 0. It's between 0 and 0.25%. Expanded lending and added a whole bunch of new programs for banking institutions in particular. Had very specific, again, emergency loan packages for AIG, for Bear Stearns, which was picked up by JP Morgan Chase. There was an aspect of the Federal Reserve Act, it's called 13.3, which means the Federal Reserve can act in unusual and exigent circumstances, and that's why a lot of those programs that you heard about, that's where they came from. I will say that that authority has been limited as a result of Congress and as a result of the financial crisis. For some, that's a good thing. For others, there's a little bit of fear. You want to have as many tools in your toolbox as possible. And then finally, again, using the unusual and exigent provisions, had more broad-based lending programs throughout to the entire financial market. So this is a subset of a graph I'm going to show you later. So this was the Fed's balance sheet in terms of emergency lending programs. Obviously, before the crisis, we had none. And then you see a massive spike. But again, they all run off. So that's one thing that the Federal Reserve does. The Federal Reserve, we're called the lender of last resort. So instead of allowing certain markets, the commercial paper market, money market funds, a whole variety of things that were under stress, instead of letting those seize, we lend. We generally lend at a penalty rate, but we're there to provide liquidity to the markets. When markets start functioning again, then we can exit those programs. And so you see the runoff fairly quickly on these graphs. The only spike at the end, we tested in 2011 and 2012 what's called a term deposit facility. So we actually we held auctions and allowed, so it's a new facility in case we need it at some point in time. So that's that later spike. So a couple other things, and Dr. Kelton referenced QE, or quantitative easing. And so we've gone through a couple rounds of that, and then basically the Federal Reserve, in addition to, you set the federal funds rate at 0 to 1%, but actually quantitative easing, actually removing quantities of mortgage bonds from the market, had the effect of pushing rates down effectively below zero. And so that's what quantitative easing was designed to do. Again, lower interest rates designed to spark more investment, and actually that piece of economic growth that we so desperately need in the economy. And we are tapering those. We're still making the purchases, just at a slower rate. So the last meeting was in March. We were at 85 billion in these types of securities per month, and we are now at 55. And I know there's been some suggestion even in the Wall Street Journal this morning that we'll go down to 45 at the next meeting. We'll see what that actually looks like. But this is the balance sheet. So this is the Federal Reserve's balance sheet. The emergency lending component that I showed in the earlier slide is just a slice of it. All the rest of this is Treasury bonds and then mortgage-backed securities as part of our third quantitative easing program. And then we implemented another tool during the financial crisis called forward guidance. And forward guidance is where we actually try to suggest some future direction for what we're thinking, right? So the Federal Reserve was notorious for being opaque. For those of you who might remember Alan Greenspan, when he was in power, they would literally make decisions, or the media would follow him based on like what book he was carrying and try to handicap perhaps what the decision was going to be or what he's thinking on interest rates. So the Fed during the financial crisis realized that being so opaque is probably not the best policy, especially if you want to reassure markets that things are happening. So they implemented this forward guidance tool, and they created a few things which I want to highlight here. The Fed, as Dr. Kelton mentioned, has a dual mandate, right? It is stable prices and maximum employment. The Fed at one point during the crisis actually set that at 6.5%. Basically saying that's our goal. Once we hit 6.5%, we know we've kind of handled the maximum employment piece. That was not necessarily without a lot of great information. There was some argument that maybe that was a little bit arbitrary. Where did that 6.5% come from? The natural rate of unemployment, those who want to be out of the workforce for a variety of good reasons, students and others, is usually hovering around 5%. So where did the 6.5% come from? And we're at 6.7 now, which I'll show in another graph. But maintain that, inflation of 2%, and then kind of when you look at long-term inflation expectations, well anchored. And I think that gets back to what Dr. Kelton was talking about as well. Our goal at the Fed is, we have a dual mandate. We want to, she kept talking about the economy being inflation constrained, and that's absolutely true. And our inflation constraint is a general target of 2%, but we also look out trying to anticipate where we may have bouts of future inflation. So that's what a lot of our programs were designed to do. So just to give you a sense, now these are forecasts. So in addition to everything else going on in the economy, the Federal Reserve made a few additional decisions or a few additional communications tools. And one was actually sharing their members' forecasts. Now the one thing they don't do is share which member said what. But out of all of the governors and all of the Reserve Bank presidents that are currently part of the Federal Open Market Committee, you can see in the broader chart to your right is the target federal funds rate. And so this is asking when they predict, and again, these are predictions, these don't always materialize. If anything the financial crisis taught us is that a lot of predictions, in fact, the vast majority of predictions are highly inaccurate. But when you look at, this is the cadre of folks who actually vote on interest rates, you see a overwhelming sense that we're looking at 2015. Now, again, it doesn't talk about necessarily when in 2015 exactly, but you can also see where they actually put the target Fed funds rate. That's the left column too. And so, yeah, you have some seeing the rate going as high as 2, as high as 4.25 over the longer run, and that is not a defined horizon. So again, to give you a sense of how the Federal Open Market Committee is thinking about future interest rates, these are published after every Federal Open Market Committee meeting. A couple other things that the Federal Open Market Committee puts out are their projections. Their projections on the unemployment rate. So here you can see, and the the dark line is actual, and then that blue line, it's we have a central tendency in the middle. So you cut out the 3 highest and the 3 lowest, and then obviously the lighter blue kind of gives you the full range of projections for the unemployment rate. But most folks have it dipping below 6%. Out into 2016. Also, when we look at actual inflation, PCE inflation, which is headline inflation, that does include food and energy costs. And again, the Fed's target is we have a target of an unofficial. Well, we have an official. We're not an inflation targeting central bank, but we generally shoot for 2%. My line's a little bit off there. I apologize, but. You see that we are still running well below that 2% now, and the forecasts are only getting us up to a 2%, at least from the FOMC members through 2016. And then looking at the change in real GDP, which I think is the key thing. We want to have a sense of how growth, what kind of growth can we expect to kind of lift the economy back. We are seeing now we do have a few, and you can see by the outliers that there are some that are concerned that we're going to have another downtick at the end of this year. You can see that in kind of the outer, the non-central tendency piece. But the vast majority of projections, so again, that central tendency, the members are projecting some kind of positive growth up to the 3% range for GDP going into 2015 and beyond. So let's talk a little bit now about the financial crisis, and then I want to get into some of the other changes that we've seen, and particularly move to the household piece. I feel so constrained here. Any issues with hearing me? Okay, someone said if I turn my head, you can't hear me. So we've seen nothing short of a complete and fundamental change of the financial landscape, and we're living it right now. And I think that's going to be very intriguing for those of us on the banking side, which is where I am going forward. But even during the financial crisis, I think this is intriguing. You look at the institutions that were on the brink of failure. Some of them actually did or were merged. At the very end, National City Bank out of Cleveland merged with PNC Bank. GMAC Financing, that's now Ally Bank. Lehman Brothers. Actually failed, but if you add up the assets of all these institutions, these were close to $9 trillion in assets. And that's kind of what we were facing, and all of those organizations have shifted in some way, shape, or form, leaving kind of a new landscape for financial intermediation. I'd like to also talk about, because this is something we spend a lot of time studying, so small community banks. So they're officially defined as having less than $10 billion in assets, but these are not the Bank of Americas of the world. These are the institutions that are part of the unique fabric of our economy in terms of financial intermediation. So many other countries, particularly in Europe, they have Canada, for example, even has 6 large banks. That's how financial intermediation happens. We have 6, well, I think 5,800. I have a number later. These financial intermediaries, as I'm sure many of you know, they operate in rural communities. They kind of serve a very specific customer base and really move through, are able to move money through these economies and spark growth, particularly in niche industries. So this is how the landscape looked in 1994. I tried to find approximately a 20-year time horizon where I could get good data. But basically what this is saying is the percentage of deposits in a general community bank at that point in time. We weren't dominated by the biggest banks as much as we are now. So the purple means more than 60% of all deposits in those particular states were held in community banks. And you can see how quickly the landscape changes. And so this is as of June 30th, 2012. Again, obviously things have shifted. You see the biggest concentration of deposits in some of the largest banks in the Northeast and some other states. We still have a kind of a healthy, kind of in the central quarter of the United States, there's still a healthy amount of community banks that provide for that financial intermediation, but in a way we're kind of consolidating financial intermediation and services into some of the largest institutions. So these are the exact numbers, 10,000, 7,000, and now to 5,700, and I moved it up to 2013. So since 2007, the overall number of community banks chartered has declined by 20%, and at the end of 2013, community banks represented 98.4% of charters. That's just a raw number, but only 16% of assets. So we've seen a big shift in assets in some of the largest institutions. You hear that despite some of the challenges among large banks during the financial crisis, what effectively happened is they kept getting bigger, and they continue to grow. Adding to that is the failure story of the financial crisis was community banks. We had a significant number, approximately 500 fail during what I would call our most recent recession. And just from a state, you can see it on a state level. So 44 states experienced at least one failure with some of the largest challenges in Florida and Georgia. I bring this up about failures because these small community banks are very much involved in industries that support growth in a lot of communities. For example, commercial real estate loans, the strip malls you see out there. Residential housing has moved a bit, but construction loans, those types of things are, especially in some communities, are very much the domain of community banks. And when you start losing that financial intermediation, you start losing that expertise, you have some challenges. You have some challenges in terms of where is that business going to go. And I mean, just in general, and you also have, it kind of creates vacuums for those communities as well. And it's not surprising that some of the biggest, this was a housing crisis that we went through on many, many levels. It's not surprising that the states that experienced some of the largest declines and largest spikes actually in mortgage delinquencies are those that also experienced a significant number of community bank failures. We still have problem banks to this day. We're not out of the woods yet. FDIC puts this out 4 times a year. I only add this because I'd like to suggest that I think we're going to see further. We're going to see further movement of the banking sector. And this is just a simple graph. If I took all the branches, headquarters of every single bank in the country, and this includes all the big guys, and I just divided it by population at the state level. And you can see that the most populous states actually have fewer options than some of the central corridor states. So depending on how you look at that, you could say, well, are they overbanked in Kansas and Nebraska? Is the type of lending that's going on there, the agricultural lending, a lot of the energy lending we've seen there, is that why you need these specialized financial intermediaries, or is this a legacy? Or are we going to look more like the coasts going forward? Demographics also work strongly against community banks, and they also work strongly against kind of the rural parts of our economy. So this graph here is, if you see a red or kind of a light red, it's an outmigration of population in that specific county. Green means either it was neutral or that they had some kind of gain. And so the years on this is pre-crisis. But we already saw a lot of outmigration from rural areas. We hear this story all the time, the urbanization of the United States, a continual movement into the larger cities. And this hasn't changed. It remains high today. So this is 2008 through 2013. We continue to see that outmigration from particularly rural areas, and the green areas are largely the major metropolitan areas. Adding again to challenges, just merger and acquisition deals. Not that you're necessarily interested in banks combining and all that, but it is a form of consolidation that we're particularly worried about. Now granted, it looks like it drops off the cliff, so that purple line is actually the number of deals, but we're not through 2014 yet, so that's not a full year. So on one hand, it may have been unwise of me to add that line in there because it's not a full year. We're not comparing apples to apples on numbers, but the interesting part is that Already in 2014, we're not even halfway through the year yet, the actual average deal value is more than everything we had last year. So what we're seeing is larger institutions. That's why I'm showing this. It's not the tiniest community banks that are merging. We're seeing larger ones. So we are becoming more of a regional big bank economy based on what we're seeing. And this is, I think this is one of the most striking graphs. In some of my presentations, I would do this exact graph all the way back to like 2008, and then when you used to flip the little book and it kind of created animation, you could see the red and green. But just to explain it real quick, it's not the greatest graph because it's kind of small. But if you have a red, it means it's a county, and it means that 12% or more of the mortgages in that county are 90 plus days past due or in foreclosure. And pretty much 90 days past due means that's pretty much it. It's interesting, if we took this back to 2008, you would see a pretty much a green, or 2007, pretty much a green nation, and it gets progressively red. And Florida has never, ever fully recovered from, at this point, from its housing woes. One of the interesting things is we're starting to also see, and this is where kind of government policy gets in there, and I think it's something worth considering. So we have a case study, I'm at the Federal Reserve Bank of St. Louis, we have a case study between Missouri and Illinois. So we have two different approaches to how we do foreclosures, and if you look at the map, Missouri is much more green than the state of Illinois. So we are, in Missouri, largely we're a non-judicial state. It means you don't have to go through a judicial process to foreclose upon one's property. In most instances, there are some exceptions in Missouri. In Illinois, you do. And so California, surprisingly, was one of those states that was incredibly red early on, and has, because they are a non-judicial state, they have been very quickly able to recover their mortgage market. It's something to think about, because on one hand, those are folks in the homes. Last I checked, Florida's, from the time of their foreclosure process, was about 500 days. That's an interesting thing to think about. They're a judicial state. The judiciary is so swamped. So from kind of a public policy standpoint, what does that mean? What does that make us think about? I mean, certainly you can get out of your foreclosure problems. Does that help in growth? But at the same time, what has that done to your local economy as well? And so we see these challenges between our two states, and clearly Florida as a judicial state, and actually Maine is a judicial state as well. So it takes longer to get through some of these things based on even government processes. I think this is generally one of the more striking tables, simply because it shows you and this, every time I use this one, it changes, because on the far right, that's peak to current decline. So from the peak price level in those cities to where it is today. And I think this is surprising. We only see one major city. This is on the Case-Shiller 10. They also do a Case-Shiller 20. But the only city that's experiencing something above its previous peak is the city of Denver. They're 2.7% above its peak. The Las Vegas is the worst, which is why I highlighted in red. So, I mean, close to 50%. In fact, at one point, it was 60. I think the worst it ever was 61 or 62%. But just think of that. You bought a home in 2000, so the market peak, that's the second column. So Las Vegas, you bought a home for $100,000 in Las Vegas, and at the market peak, April 2006, and now that house is worth 65.2. I mean, that's insane, and it was worse before. So we're seeing some recovery, but we talk about, and Dr. Kelton talked about, where is this growth going to come from? It's going to be really hard for growth to come from certain parts of the economy that are housing constrained. And there's some demographic factors at play too, because and I'll get into those a little bit later, but when the largest asset that the average American will hold is their home, and it's lost 44.8% of its value, you're not inclined to spend. You're not inclined to follow that good advice from Dr. Kelton and get the economy moving. You're looking at a massive and really unsustainable hit to your balance sheet and to your bottom line. And so that's housing is a big problem. She mentioned before she looks at housing indicators. We look very closely at housing because, like it or not, and we are seeing some shifts, a lot more renters, a lot more folks wanting that mobility of not owning a home and saying, you know what, I want to go where that next great job is. Why the heck do I want to why do I want to own anything? So we're seeing that too, but that's going to work against. It's going to work against a prior generation that's looking to retire and that was so in that mindset of housing. It's a type of forced savings. It's a way to build wealth. The market's only as good as your product's only as valuable as what someone's willing to pay for it. And if no one wants it anymore, or not as many people want it, you're not going to get those prices. In general, just real quick, we are seeing some better performance. I'll just direct your attention to the far right. Return on assets is a measure of how banks are doing. 1% is usually our gauge that things are getting better. So we're seeing some. I won't get into all these specifics of what they are, but in general, we're seeing a better trend in our banking industry. So despite some of those housing problems, banks are finding new ways to raise revenues. We are seeing a decline in the unemployment rate. Although the unemployment rate is a choppy number, right? Because it's folks who are actively looking. Dr. Kelton talked about a lot of folks have dropped out of the labor force, and it's actually been very volatile. It went down to 6.6. It's now back up to 6.7. It's been hovering. As the economy gets better, we think some people come back in that maybe didn't really report that they were ever going to come back in before. Some folks who maybe said, I'll just take early retirement. We might be seeing some shifts there. So there's the unemployment rate is really, really hard to gauge right now because it's we're in a kind of a volatile state for our economy. And I'll just go with, again, we want to understand credit standards, right? Because so many folks need credit in order to build wealth, in order to buy that house. Few of us, I'm sure, are paying cash. Few of us are plunking down cash for college. Few of us are, a lot of those investments and a lot of those things we want to make, we need lending. We need some kind of intermediation. And so, on the one hand, now this is for residential mortgage loans, and this is just, so the zero line really just shows if it's above, are credit standards tightening or are they loosening? So if it's below the line, you're seeing some kind of positive, meaning, well, depending on how you view it, access to credit's a little easier right now. If it's below, access to credit is tougher. If it's above, I'm going to show you this other chart a little more granular. So credit standards in recent, from 2007 to 2013, so really the financial crisis period, this is where we see that credit is fantastic. This is residential mortgage. If you have a great credit score, chances of getting a residential mortgage loan is extremely high. Anything less than that you see is above that line, is extremely, extremely credit constrained. So we've put a penalty on taking risk in terms of the mortgage market as a result of the financial crisis, and I'll talk about the regulatory response too, because I think that's a big drag on our economy. This next chart is this is showing residential mortgage demand as well, and so we are seeing less demand in kind of recent years. Good news, CRE, commercial real estate. So we are seeing some positive signs. Banks are very much. These are credit standards for commercial real estate loans. We're seeing a loosening of standards overall. So the banks are trying to move money in the economy. They've got a little bit more confidence. They feel comfortable. And also just general commercial and industrial loans, equipment loans. These are the types of things. Again, we're below that line. So we're seeing some movement. So there is, I hate making this a completely negative presentation because it's not that. But now I'd like to talk about the U.S. consumer. And so we launched last May, so we're coming up on 1 year. It's called the Center for Household Financial Stability. It's this, we believe that since so much of the economy is based on consumer spending, that the health of the consumer is going to have, and the willingness, as Dr. Kelton said, for the consumer to spend is going to have a big effect on the macroeconomy. And that's, I think we all generally accept in a consumer spending economy that's going to be the case. But there has not been a concerted effort to actually study balance sheets on a household level and try to understand what's constraining that spending at the individual home level. So that's why we launched this center. We're starting to find some conclusions here, and I'll go through those now. So in general, what we're seeing, and again, a lot of this is not a surprise to any of us, so a substantial loss of income and wealth. For most families, their balance sheets, their home balance sheets, kind of assets, liabilities are still extremely weak. Why I get into all that banking stuff. So fewer traditional financial intermediaries. That's a bit of a problem. For some institutions, you may not have had the best credit score, but when you had a lot of financial intermediation, you had personal relationships, you had an option, or you had more options. So I'm always concerned, we're always concerned at the Fed, when you start consolidating financial intermediaries, you have fewer choice, or you have fewer financial institutions that either understand you at a balance sheet level or your business. We hear that all the time, particularly in folks who are trying to do some interesting things on the business front, and they can't find a bank that feels comfortable underwriting certain types of loans. And so, and they're all over the place. I mean, there's so many great stories that. Of banks. There's one that specializes in North Carolina that exclusively specializes in lending to dentists. If you're a dentist, you're going to probably, wherever you are in the country, you're probably going to find this small community bank because they know, they feel comfortable and they know how to underwrite everything that you need. The bank has almost become like a one-stop shop for like, oh, I got my DDS, I'm going to need this and this. That's the value, I think, of kind of diversified and robust financial intermediation that we're consolidating. And then the last piece is new regulations. New regulations is a big overhang. I think we have to decide as a society how much is too much and how much is too little. I will say we are in the age of the consumer on the regulatory front. Everything is very, very consumer focused. Right? We all heard terrible stories during the financial crisis of someone refinancing some 90-year-old person into some mortgage that he or she couldn't afford, and that's a horrible story. But I wonder to what extent have the regulations kind of overreacted to the extreme cases that we heard during the crisis, and is it at the expense of future growth? So let me get specific about the impact of the recession on balance sheets. So $16 trillion in household wealth. The vast majority of that was housing, right? So the biggest asset on a family balance sheet is the home, generally. And so when you saw housing prices, you saw that map earlier, you saw that 90-plus day in foreclosure, you saw the housing table. That's where $16 trillion in lost wealth during that financial crisis period comes from. Now in nominal terms, so let's not inflation adjusted, and a lot of times you'll hear in the press, the wealth has more than recovered. Right? So if you just look at a fixed number of how much wealth was lost during the financial crisis and you take the same fixed number today, we're at 114%. We're back on track. Inflation adjusted, it tells a different story. And particularly, you add in population growth trends as well, new household formation, and only 63% from our analysis has been recovered at this point. And here's the big thing, the wealth has been recovered in stocks. Dr. Kelton talked about that at the very end. The vast majority, when you look at the stock market, it's fantastic. I actually feel like a genius. I joined the St. Louis Fed in March of 2009. When many employers, they set you up with a 401k and all that. That happened to be the bottom. So like when I look today, I'm like, oh my God, I nailed it. But yeah, it's right. It hasn't been in housing; it's been in stocks, and so that is going to kind of shift where this the recovery is going to hit a certain slice of the population so much more than others. We saw the loss in housing, 30% is kind of an aggregate national number. And then here's the thing that we've started to slice and dice. We've started to look at demographics in our center. And what are we seeing? We're seeing, and I only boldface the better educated because I'm at a university today. I'll drop the better educated in other places because they're all significant factors. Younger, less educated, and non-white families lost the most wealth. Older, better educated, and really even if you break down the demographic categories further, white and Asian families have recovered really extremely well, and I'll show you some charts to that effect. So let's look at household incomes. This is not wealth, this is just income. This is what they're bringing in, and I want to distinguish that because I'm going to get to wealth in a second. And this is a nice example of the difference between mean and median, right? So the blue is mean household income. What we always do at the Fed is we just kind of index it, so we take it back to a year. We took it back to 1965, and we said, let's just set that at a number. And so we set it at 100. That allows you to kind of see, if you set two things equal, it allows you to see how they've moved. And basically what you see is, so good news, income has gone up, that's good. And this is inflation adjusted, so income has gone up since 1965. Generally, that's the general trend. We see a huge drop on the median, but look at the mean. Sure, there was a drop in the mean, but really what happened there? What happened you see that huge blue line in the mean That's the internet tech boom and all that. So when you have a much higher mean than the median, it means it's skewed to higher income individuals. So sure, median has increased, but really what we're seeing is a significant growth in mean household income, which means we're seeing a significant growth in upper income families. So let's look at, I'll break it down by some age categories. Again, we have, I violated a St. Louis Fed rule, which you only have 4 lines on a graph, but I had to get all the age categories in there. But I think the most compelling line is the top line, that is age 65 and older. And what we're seeing, again, we indexed it back to 1965, and you see that income in general, inflation adjusted median household income has more than doubled for that group. Now granted, older folks have had longer time to, but this is income. So I guess I got ahead of myself. So yes, wealth is a different story. Older individuals have had more time. But in general, what we are seeing is there's a certain age cohort that is doing much, much better than on the income side than younger age cohorts. And we hear this all the time, but here's the data, right? So the value of a college degree. And so the top line that you see, and everybody took a hit, this is household income by education level. Everyone took a hit, but that top line is a bachelor's degree or higher. And it's just because of the lack of the data. I'd actually like to see the differentiation, bachelor's and above, but we just don't have that at this point. Income differences between racial and ethnic groups. Again, this is median. White families are in the blue, Asian, and then purple is Hispanic, and then black families in the green there. So again, you see the dispersion around race on income. And then I just like to so that was median. Now you flip it to mean, and you actually see that among Asian families in the red, that it actually flips between the white and the Asian, so that we are actually seeing a lot more Asian families really at the extreme upper end of the income scale, at least from the data that we have. So now let's go to wealth. This is really the big, this is the big piece, right? So this is your overall net worth. So mean and median, once again. Mean wealth is at an all-time high, but median wealth, not so much. We've seen mean wealth of young families decline so much, and when you think that some of those who are getting into that cohort, a lot of these age categories might have just been buying homes around 2006. They might be those folks who bought into the peak and now have lost on average of 30% of their wealth. For many of the, for some of the older age cohorts on wealth, especially when you look at housing, you're going to see individuals who probably bought their homes prior, maybe experienced the peak, maybe cashed out on that peak. So you see a lot more change in that in terms of wealth. And this is, quite honestly, due to too much exposure to housing. So that blue line is the under 40 line. So that's when you look at the share of residential real estate of a family's total share of their assets, you see that housing means so much more from an asset perspective for folks under 40 than it does for the other age cohorts, and particularly the 62 and older as well. They've had more time to diversify their assets. And again, too much debt. So this is total liabilities to assets by family household. And again, the blue line is the younger cohort. So we've got a lot of debt. We hear stories about a lot of student debt. We've got a lot of housing debt among that particular age cohort. And it's really had a significant impact on overall household wealth. And so now to couple all that, now we're actually seeing the declining home ownership rates. Right? So the big goal of some of our housing programs and Fannie Mae and Freddie Mac and housing goals that were instituted for some of those organizations, and we're just seeing what I would call, I guess I personally feel that there's a bit of a secular drop. I think tastes have changed. I think folks want some of that mobility. I think you want to go to the next job that's out there, and that notion that housing will go up forever, that rule of thumb has been debunked a bit, and I think folks are hesitant to actually get back into the housing market. So again, you see home ownership rates, in this case the under 40 is the green line. You see those declining significantly. And then, and again, I feel like we can't stress this enough, but the wealth differences by education, so we did income differences before, but wealth differences are are pretty staggering. So if we're kind of looking at this bifurcation of American society and realize that, that line starts very much with education and then moves through some other factors as well. So kind of looking ahead, right? So we're kind of thinking, how will families be able to survive? What is growth? What does economic growth look like in this country from a family and from a balance sheet perspective? So here are some concerns, but I think every concern's got two sides, right? So first off, tight mortgage credit. We saw tight mortgage credit or mortgage credit standards tightening for some of the those with less than stellar credit scores. Prime credit can get access. There are some new underwriting standards in place. I can get into those. I could probably spend way too much time talking about those. So on one hand, we saw excessive debt levels are a drag on many households, but we still need credit, right? We still need credit. It's vital for building wealth, particularly for education. The other piece is, the college wage premium continues to increase. I always get some negative on this for the right majors. I don't know what those right majors are, right? I mean, there was an old interview with Warren Buffett, and he said, I know how to allocate capital, and that's what people put a premium on, so I make a lot of money now. But put me back 100 years ago, or 200 years ago, or in medieval times, allocation of capital, you needed to be good with a sword or something. So, it's what is the right major at the right time. We don't always know. There's a center at Georgetown University that kind of constantly tracks majors and employment rates, and I'm always curious about that, but how do you ascribe anything? Like actuarial science is always, pretty much sounds like if you're an actuary, you will always have a job for the rest of your life. But I should have put the reference there, because it's interesting to kind of go through what Georgetown is putting out on different majors, but it's going to be the right fit at the right time. And as this economy, and when you're in a dynamic economy like the United States, it's the possibilities are fairly endless. But yeah, there clearly is a wage premium that we've seen both on income and wealth. And then I think the other thing is just lower rates of home ownership in general, for the reason I suggested before. If you are one of those older Americans looking to downsize, you may not have the market for that house, which may depress prices, which could impact your balance sheet. If you are not necessarily interested in home ownership, maybe rental opportunities look a little bit better, and that may shift the market a bit too. So there's some positives. I talked about labor mobility. Great job in New York. I'm moving there, and as soon as I'm not, I'm moving to LA, and as soon as that runs out, I'm moving to Paris. It also means, we saw housing is illiquid, although we tried to make it more liquid with some of the cash-out refinancings. Undiversified, right? It is a house, and most people are over-leveraged. Most people aren't paying cash, so maybe that's a good thing. Lower home ownership rates mean one less really burdensome asset, but home ownership is a performing asset. It's a place to stay. And it's also a mechanism for forced savings. There are some that kind of look at just savings in general. And I know that the previous speaker wasn't a big fan of that. Our sense is that having some sense of confidence in, especially the Center for Household Financial Stability, having a sense that your family balance sheet is at least able to withstand some kind of shock leads to a little more confidence and makes one more willing to take risk and other things too. So I think there's a balance there, and housing has traditionally been a mechanism for forced savings. My final piece, I just want to say a few words. I will tell you, the Dodd-Frank Act was 2,300 pages, and I was the guy who got stuck reading it and reporting at the St. Louis Fed. We all so I know it extremely well, but I'll just highlight a few things. So the Consumer Financial Protection Bureau was launched, it was authorized in July of 2010. It went into operation of July 2011. You may have been, many students here, you may have been received materials, or they're very much looking at student debt. That's a big issue for them. They're very focused on for-profit colleges. One of the things that I found extremely interesting is that whereas in the Federal Reserve or the FDIC, we look at banking organizations, that's who we supervise and regulate, they can get everybody. So anyone who offers a financial product or service could potentially come under their purview. I find that interesting. That's an interesting level of authority. You know, I think one of the greatest ironies of the St. Louis Fed is directly across from our building is a payday lender. I've never seen any of my colleagues go into that payday lender, and I am not, obviously I'm on camera, I am not an advocate for using a payday lender, but I will also say that I can fully appreciate that there are circumstances in some individual's life where that actually might represent a rational financial choice at that point in time. And so, again, I spent a lot of time earlier in my presentation about loss of financial intermediation, and that's why I bring that up. Again, I'm not, let's solve our financial intermediation problems through payday lenders, but let's also acknowledge that it's not just one massive scam. They serve a need. An industry's not going to be around for 30, 40, however long they are, without some kind of benefit. You know, it's not just it's not just an extraction. They're meeting a need, and I cite them, but there's a lot of those types of things that I think on the surface we react very negatively to, but at the same time, you know, I saw it in their approach on for-profit colleges, you know, like, oh my goodness, you know, you go to one of these kind of for-profit trade-style colleges, what does that degree actually mean? But I don't know, some people come out with something very useful in the economy, and some don't, and some really, really don't, and that's a problem. And I know they're looking at that, but you know, they've already gone after payday lenders, student loans, auto lenders, and maybe that's a good thing, but I worry as someone on the banking side about constrained credit, because I think it's so important for us to be able to move forward. Speaking of constrained credit, so this is a study that I'm currently undertaking. We launched a survey April 15th. So the qualified mortgage rule and the ability to repay standard, this may mean absolutely nothing to you, but it will. So basically what happened is, as a result of the financial crisis, a rule was passed in Dodd-Frank that basically said it institutionalized, I'll call it institutionalized a 30-year fixed rate mortgage. It basically said that's the safe mortgage. There's a lot of reasons why that is a bad financial decision for many of us, but it also is a regular streaming payment, that's fine. So it institutionalized that, and it basically put a whole bunch of conditions, and it said, banks, if you make a qualified mortgage, if you do that, we will release you from liability. So it kind of gave them, the legal term is a safe haven. It gave them a safe haven in the law. So if you follow, and it's a whole list of things, and I actually had it in earlier, and Rob said, what the heck is that? And you know what, it was a terrible chart, so it's gone. But I could explain it so much better. So basically, debt to income ratio fixed at 43%. Doesn't matter what your stream of income is, what you do, debt to income ratio fixed at 43%. Doesn't matter where you are in your life. To get a qualified mortgage, your debt to income better be 43% or less to qualify for a qualified mortgage rule. Now, the Consumer Financial Protection Bureau will say that's just for a qualified mortgage, but you can still originate a non-qualified mortgage, so that's the second piece, the ability to repay standard. We just want to make sure that people can repay the mortgage. Fantastic. Everybody should, obviously, that's what underwriting is. We should make sure people can repay the mortgage. So the study we started on April 15th is we want to know how many banks are actually going to, and it's an anonymous study because they'll never agree to put their name to it. How many are going to say, I am only making qualified mortgages? Because if that's the case, those of you may have had a bad run on a credit score. I don't think I did all that great when I was in college. I didn't check my score, but I'm sure it was abysmal right afterwards. We're going to have a bit of a problem getting mortgage credit if we want it. Especially if if this is creating incentives to force banks and other lending institutions to only to create mortgages under a very narrow set of rules. So I raised that up there, and you know, the last one, that's why I like the disclaimer at the beginning of my presentation, because this is just a pet peeve of mine. But you know, so we went through a financial crisis. You saw trillions of assets at stake. People lost their homes, foreclosure. And we spent the first 6 months, right? So the federal regulatory agencies used to put out charts of how much time they spent on different aspects of Dodd-Frank to try to figure out this new rule. There was a period of time where we spent more time on the Durbin Amendment and I'll tell you what that is in a second, but the Durbin Amendment than anything else going on. The Durbin Amendment basically says that the fees that when you swipe your debit card are now fixed. The Federal Reserve is required to fix them. So it's not like we like to fix them. We are usually very open market about things. We're required to fix them. And you've probably noticed that, there used to be those commercials, right? Visa and MasterCard, and you swipe your debit and you could move through the line, and then that person who either paid cash or they stopped the whole line. It was terrible. Has anybody been incented for a reward program in the past couple of years for their debit card? I'm curious. It's all credit, right? So that's the other thing, right? So we got folks to maybe be a little more responsible on moving away from credit into debit, not necessarily racking up those fees, keeping that money for other productive means instead of, finance charges on their credit card. And now we've basically created an incentive so that debit cards they exist, we all use them, I know, but the incentive is not there. Your bank is certainly not going to incent you to use them because the fees on debit are constrained by law now. We spent a lot of legislative energy doing that, but credit is not. So it's very interesting. And there's so many interesting things about Dodd-Frank, and we're going to be living with them for a while, but from our point of view, I wanted to at least highlight the housing ones because those are the things when we look at a family balance sheet and we look at some of the challenges. Yes, there is a regulatory piece, and I think a lot of it is very well intentioned, but when it starts constraining credit, I think that's a bit of a problem. So generally, overall, growth in economic activity, it has picked up. We're seeing that. We're not at the GDP levels that we'd like to see, but you saw some of the Federal Reserve FOMC members' predictions. Those are on an up and up. We're seeing improvements in the labor markets, but that's choppy, 6.7%, not great. Household balance sheets still extremely fragile, especially as long as we are underexposed to financial markets and overexposed to housing. And then finally, lots of uncertainty facing consumers and businesses. Hopefully, the regulatory piece is one of them, but I know you're going to hear about affordable care and all that. There's a lot out there that is creating uncertainty, and uncertainty tends to create inertia. Stop. Let's figure it out before I jump in. And so that's what we're looking at the Fed. It's not the rosiest picture, but it's certainly a lot better than where we were. And so thank you for your time. I'm happy to answer any questions you might have on the Fed, on this presentation, and just want to thank Dr. Weegley as well for the opportunity. So thank you.